You're now listening to the Supply Chain Secrets Podcast, the ultimate insider's guide for all things ocean shipping. Presented by NYSHEX.
Hi, friends. Welcome back to the Supply Chain Secrets Podcast. I'm your co-host, Caroline Weaver, and with me is Lars Jensen.
Hi, all.
And we've got a really fun episode today. We're going to be talking about the new NYSHEX Freight Index that was released earlier this week. But before we get into that, Lars, tell us what's happening in the market in terms of current events.
Yeah, well, the market is never boring. There's never a dull moment these weeks. There's always something going on, right? So if we start there, let's call it the boring stuff. There is no change. We are still in the midst of tariff turmoil, to put it mildly. We still see a raft of blank sailings as a consequence of these. There's not really any change compared to when we spoke about this last time. What a lot of importers are then going to be feeling is the downfall in vessels that's going to arrive on the US West Coast. Maybe one data point to throw out there is the one we heard just yesterday from Gene Soroka, the executive director at the Port of Los Angeles, saying that next week we're going to see 35% less vessel arrivals coming into the Port of Los Angeles. And I bet you it is going to be no different in Long Beach, in Oakland, in Seattle, in Tacoma, and all the West Coast. And this, of course, is then also going to hit the East Coast a couple of weeks later on, simply because the sailing time is longer. This is just the domino effect of decisions that were made a month ago when the tariffs were involved. Of course, it also means for practical purposes, if, and I stress the if, the trade war is resolved, this downfall is going to continue for the next month. I mean, these ships have already left China, or Asia for that matter. We're going to see that continue. On other changes, it should be noted this is less relevant for full containers, more for air freight actually. But the abolition of the de minimis regulation, the one where you don't pay any duties or tariffs on small parcels coming into the US, that one expired yesterday. So everyone that's been buying small parcels off typically say Temu or Shine or anyone else, well, that is going to be placed with tariffs as of yesterday. The first consequence we've seen in practice is Temu, the large Chinese company, have announced that they're no longer selling stuff from China to US consumers, not shipping it direct at all. This is going to have quite interesting repercussions over on the whole air freight market. Apart from that, no changes really from a US standpoint, no changes in the Red Sea. No changes here means we are still seeing US strikes. We are still seeing the Houthis have the ability to shoot missiles. So everybody going around Africa. No changes in the conflict between India and Pakistan, which unfortunately also means a very high degree of tension. And there is still the risk that shipping lines might have to disentangle some of their services, where a lot of the services from the Indian subcontinent to, for example, US and Europe tend to have vessels calling both Indian and Pakistani ports. For now, that's unchanged. The risk with the tension is if you get more sanctions between India and Pakistan, you might have to disentangle those services. In that case, that would mean added delays of cargo to and from the subcontinent, more transshipment. So just for everybody out there that are shipping in those ports, be mindful that this might come and your cargo might suffer further delays as a consequence.
A bit of a tricky situation right now with all of the network changes that are happening or could happen.
Yeah, exactly. Maybe to just sprinkle a tiny bit of good news into those ones is some of the latest reliability measurements that's actually vessel arrivals during March, so just before the tariffs really kicked in. The new networks, both from Gemini and from MSC standalone and from Premier Alliance, are indeed showing reliability that is better than what we had under the old Alliance regime. So that is undisputably good news, but even though it's good news, I wouldn't count on this lasting as we now get into the tariff disruptions. Unfortunately, we're going to see some impact from that as well. But if we want the good news, that's at least part of it. That also brings us up to what is happening in terms of freight rates. As I mentioned, we had a raft of blank sailings. The problem with freight rates out of Asia, especially on the Trans-Pacific, is this impact on the tariffs, because we still have massive tariff walls between China and the US in both directions. At the same time, tariffs have not been abolished on the rest of the world. Keep in mind, everyone is still subject to 10% tariff. It is a major hike. But we have the reciprocal tariffs on pause. And just to remind everyone, how big were the reciprocals? Well, in cases like Cambodia, we were up at 47 or 48% tariff. So that's what is on pause right now. So we do have this skewing of the market where we're seeing a boom from the rest of Asia into North America and a complete and utter disaster in terms of volumes out of China. Carriers are, of course, reallocating space on vessels. Some of them are blanking. Gemini actually is not blanking, but what they're doing is they're phasing in slightly smaller vessels in order to manage capacity as well. Can we see that on the rates? Actually, we can. We're now beginning to see the new weekly data come in from the NYSHEX index. And what I would point to as at least some of the data points we saw in the data that just came out yesterday is yes, we are seeing drops in rates out of China. We have not seen that for a little while, but we are seeing also a bifurcation where rate developments from the rest of Asia tends to differ from what we see out of China. Now, what we saw was first an expansion in the spread that typically exists between China and, for example, Southeast Asia. Now, very curiously, what we saw in the new data yesterday was a sudden drop out of Southeast Asia, but we're seeing an increase in rates out of Northeast Asia. And I think some of these reverberations we are seeing is driven by the difficulty US importers are having in terms of how should they manage their supply chain. What are the goods that they need to front load ASAP before the expected reintroduction of tariffs? That's just 2 months away now. So what are the precise goods they need to get imported? Are they going to come from Korea? Are they going to come from Vietnam? I think these reverberations, these huge ups and downs are going to be the name of the day for the next weeks and months as well. But maybe I'm getting slightly ahead of myself. I mean, you were teeing it up nicely initially, Caroline, that there is indeed something called the NYSHEX index. I was blindly jumping in and say these are actually some of the things we're already seeing. But maybe handing back to you and Rich to explore a little bit more. What is this new spot rate index?
Yeah, well, the cat is out of the bag here, but let's talk a little bit more about it. So we have Rich Heath here with us. He is the Vice President of Freight Products and Services at NYSHEX, and he has been spearheading the launch of the NYSHEX Beta Index. So, Rich, let's talk a little bit about your background. Like, how did you end up being the one that's spearheading the project? What's your expertise in this space?
First of all, thanks for having me today. It's really great to be with you guys. I began my career in the container shipping industry, with a major liner company before moving to the financial industry to work in freight and commodity derivative areas. And over the years, I've worked with a number of different financial products in different markets and different indices and different index providers. And so when the opportunity came up for me to come home, I guess, back to where my career began in container shipping, and with an opportunity to create something that could really benefit the industry and create long-term lasting value. It was just an opportunity that was too good to miss.
And what made you think this is a problem that is worth solving now?
We've seen in the industry over the last 5 years this ever kind of increasing rate of black swan events. And Lars, I think I heard you refer to them last week as grey pigeons now because they're becoming so commonplace. And really what's kind of changed with these as well is not just the frequency of them, but the impact that they're having on the market and the amount that rates are actually being moved by these events. So I think the risk in the market has significantly increased in the last 5 years, and that has got everyone talking again and investigating tools to manage that risk, tools like index-linked contracting, potentially derivatives, and of course the indices. And so at NYSHEX, we looked at the indices that are out there and we saw some challenges, and we thought there was an opportunity to bring to market a new index which covers some of those challenges and can really give the industry those tools that it needs.
Can you tell us a little bit about what makes the NYSHEX Freight Index different than the ones that are currently available?
When you look at other indices in the market today, they all have different challenges. And one is the fact that they're built on quoted rates. Now, liners, NVOCCs quote a huge number of rates every day, and the vast majority of them never end up resulting in the shipment of a container. So NYSHEX indices, they're based on settled rates. We're surveying in the market shipments which moved in the previous week and the rates at which they moved at. And so we know that all of the rates that go into the index calculation are the market rate that was required to actually move a box on that route in that week. And so I think that's a really important point of differentiation from an accuracy perspective, because it's very important that we know what the actual accurate market rate is. The other challenge that we're looking to solve is the coverage. So today there are different indices available. They all have different levels of coverage, and they also have different levels of accessibility. So some, of course, are only ex-China. If your supply chain is not only ex-China, or perhaps you're moving your sourcing because of current events, then you need more data than just ex-China. Others provide larger coverage, but they can be very expensive to subscribe to. And if you want to use an index and you want to use it with your partners, then you're in a situation where you're creating the need for multiple subscriptions. So let's say I'm a shipper, I need a subscription. My carrier partner needs a subscription. My NVOCC partner needs a subscription. If those subscriptions are expensive, then that's adding a lot of additional costs around tools which are there primarily to manage and potentially even reduce costs. So NYSHEX, our indices will be global in coverage. We've started with a relatively small subset, but we're scaling that up over the course of this year. So regardless of people's supply chains and where they're sourcing from and where they're shipping to, they will be able to have a NYSHEX index which covers those trade lanes. And our indices are free to use for everyone in the industry, for carriers, for shippers, the OCCs. So they're designed to be a true utility to the markets. There's no barriers to entry. And then the final area where we're different is in terms of the independence and the balance that we've got from the organizations who are contributing rates to the index. One of the other challenges with some of the products out there at the moment is that they're quite one-sided. Perhaps the rates are only coming from one particular market segment. You know, if you have an index which is exclusively shipping lines providing the rates, then it's less likely that shippers will trust that. If it's the other way around, it's less likely that carriers will trust that. So we need to have indices without any potential inherent bias in them. NYSHEX, we're a trusted third party in the market already. And the organisations providing rates to our index are a mix of both shipping lines and NVOCCs for our spot indices. So we have effectively both sides of the market covered.
Maybe just also a clarifying question here is, I mean, you're measuring spot rates, but as we all know, cargo can be booked at a huge variety of different dates prior to the cargo actually getting on. So how do you deal with the fact that spot rates might actually change over the course of that booking uptake period?
Yeah, so we measure a number of different dates within the sample. One of them is indeed the booking date, and we're looking for short-term spot cargo. So we don't take rates in there which are booked any more than 4 weeks in advance of the sailing dates, because that was the feedback that the data providers gave us, as saying, you know, well, this is effectively the longest time that you can book. For that booked rate to then make it into the index, it has to have either gated in for FMC regulated trades, which is the time at which, you know, we're saying the price is locked when it gates in on FMC regulated trades, and sailed for non-FMC regulated trades. So we know that that rate was booked within a short-term window, and that container has actually made it onto the ship and has sailed, so that we have that integrity across those different timestamps.
And how do you access the index?
So that's super easy. You can access it via NYSHEX's websites. You just go to nyshex.com/indices. You can create an account on there, and then we provide you with a password and log into the platform, and you can dive in and see the product straight away. Right now you see the three trade lanes that we've gone live with, which is the Trans-Pacific and Transatlantic.
And what sort of capabilities do you think will open up as this index takes off, as it develops? And what are some of the use cases for shippers and NVOs?
There's three major use cases. First of all, simple one is market information and transparency. I think that's something which can benefit everyone. It's not exclusively good for NVOs or carriers or shippers. It works for everyone to have more information and more transparency. The next one is the potential to use index-linked contracts. So if that's something that people want to do, if that's part of the way that they want to manage their supply chain, then you need a trustworthy index to do that. And those type of agreements, I think they're really interesting for the market. They have the potential to align the interests of the carriers and shippers by creating a rate that maintains, the market trends. And so that's the next area that people can look at to use index-linked contracting. And then the final one is the derivatives. We've talked about derivatives for quite a long time now in container shipping. They're yet to really take hold, but they're an important piece of the puzzle. And at NYSHEX, our indices will create derivatives products with our partner ICE, and they'll be launched by the end of this year. And I think it's really critical that you have all of those different tools available to you on the same index, wherever you want to apply them, in a format that is easy to get access to and easy for everyone to use. So whichever parts of that toolkit you want to use, it's all there for you. And it's not a one size fits all, or you have to use every option, but they're all there against the same index should you need them.
Well, let's talk a little bit about the actual launch. So on April 30th of this week, we hosted a big event at the iconic New York Stock Exchange, which was a very incredible experience. We had a whole bunch of senior logistics leaders, as well as people from the financial sector. It was a really interesting blend of audience members, and we had a bunch of panels. We broke up into different table conversations. And Lars, you were a speaker there. You also did the closing notes. So I want to kick it over to you to hear more about how you think the event went. What are some of the learnings?
Yeah, no, it definitely was a great event. To maybe boil it down to a very, very brief overview, first of all, there seemed to be general consensus that the supply chain is not broken. It never has been broken. From the perspective that freight is indeed moving, even during the worst of the pandemic, even during the Red Sea crisis, now with all the tariff turmoil, freight is still moving, but of course it's changing. So nobody should be looking for a solution to fix the supply chain. It doesn't need fixing. It's flexible. But the unpredictability of the market has reached a scale we have not seen before. Again, both during the pandemic and then during the Red Sea, now during the tariff. And no one should be under any illusion that this is going to stabilize anytime soon. And that means not from the perspective of the entire supply chain, but from the perspective of the individual companies that participate in their supply chain. It is important to have better tools on how to manage your own business. Because whereas the supply chain is not going to stop, this kind of turmoil is what can make or break individual companies, be that shipping lines, be that NVOs or forwarders, be that individual cargo owners. So it's a matter of managing your own business through this turmoil. And not that there's ever going to be one tool that will solve every single problem for a stakeholder, but there was also a recognition that moving down the path of more index-linked contracts opens up new and better opportunities for managing the supply chain. One thing maybe to start off with here is the traditional contracts. I was about to say that we all know and love, but at least we know them for decades in this industry. I mean, this is not a surprise to anyone. They tend to be unenforceable. That is not new. That's not even 5 years old. That is 20, 30 years old. But the magnitude of the swings in the supply chain makes this a much more pertinent problem. And that means as a supply chain manager out there, the traditional contracts do not do a very good job of securing both your physical supply chain and the financial stability of your supply chain. What is being recognized here is with an index-linked contract, at least a supply chain manager can do one thing. He can secure the physical part of his supply chain, no matter whether the rates go up and down. That is an important parameter. That, of course, comes with some unpredictability on the freight rate, but as I just mentioned, it is an illusion that you can both have space guarantee and a completely fixed freight rate, especially when the market suddenly tightens because of unforeseen events or black swans. What this then allows is, let's call it a constructive discussion between a supply chain manager and typically the finance director of the company, saying, fine, I can secure the physical supply chain. If you don't like the variability of pricing, then on the back of this, you might be able to then use financial instruments that many of these financial directors are used to using already when it comes to hedging off, say, currency fluctuations you might have out there. They might also do it against interest rates fluctuations. So these are well-known tools. Now, that doesn't mean you have to. I mean, it's perfectly valid for a company to say, we can live with the variability in the price of freight rates, but we cannot live with the unpredictability of whether the goods move or not. So what we're getting into here is a very good tool for managing some of the supply chain risks, and at least from my perspective, placing the risks where they actually belong logically in a company. So the risk of the physical supply chain, of physically moving goods, yes, that does rest with the supply chain manager. The financial risk rests with the CFO, again, where it rightfully should be. So overall, my takeaway from that was there was a great deal of enthusiasm amongst the, what was it, 100 plus people that participated in the iconic
150?
stock exchange main room in there. And most of them there, I really sense a kind of enthusiasm. And yes, this is a good tool, not for solving all problems in the world, not for solving all problems in supply chain, but for addressing this very particular issue we have when it comes to the utter unpredictability, uh, given all the black swan events we have out there.
That's a great summary of it. And I agree. I think a lot of the attendees, including myself, felt very energized leaving that event and just really excited for what the future has in store. Rich, I want to ask you what your takeaways from the event were.
I just really felt like everyone had come to learn. Everyone was very open and engaged. And that really echoes what I've seen in the industry since I've come back to the market, which is just how curious and keen to learn people are about these tools, which parts of these work for me, which are the risks that I can live with, which are the ones that I can't live with, and how do I then use these to build something that really works for my organization.
Yeah, and maybe to add on that, one of the questions that were also raised and discussed during that day was also, why is it different now? I mean, as you were also mentioning, Rich, it's not the first time we've seen the market try to introduce, for example, derivatives. Last there was a major push, that's about 15 years ago. And at that time, it didn't really gain a lot of traction. So the obvious question is, should we expect any different this time? What is different? And what I see is two things. First of all, the market has gained a great deal of maturity in understanding how we actually function. But more importantly, the magnitude of the disruptions in the supply chain over the last 5 years are just much, much higher than what we were used to. Maybe exaggerating slightly, but I was about to say in the good old days, it was seen as a disaster if freight rates suddenly changed by $200. Now, if you look over the last 5 years, a change of $200, that small change, it's almost not noticeable given the sudden changes of thousands of dollars up and down. So the sheer magnitude of the problem is simply what is different this time around. And at least in that room, I didn't sense that anybody was under any illusion that this level of volatility was going to go away again. This is part of the new normal.
All right. Well, thank you both for being here with me today. Moving forward with these episodes, we'll be talking about the latest numbers out of the index. So you'll get the mix of market news as usual, and we'll talk about the newest rates. Until then, I hope everything goes well for both of you and for all of our listeners.
Thanks for listening to Supply Chain Secrets Podcast, presented by NYSHEX. Be sure to subscribe on your favorite podcast app. Want to be a part of the show? Register to attend a live recording at the link below.